Welcome to chapter 17. What is a yield curve? In this chapter, we have two objectives. The first one is to know what a yield curve is, and the second objective is how can I use a yield curve to predict market behavior. So let's get started. When you get into stock and bond investing, everyone wants to be able to predict the future, but in most cases, that's pretty hard to do. And it's pretty much impossible to do. But one of the little tools we have at our disposal to help analyze where our current market condition is, where it might be going in the future is yield curve. So this is really important tool that you really got to understand in order to be successful stock and bond investor. So what is a yield curve? So on the screen I have a generic yield curve. If you look over on the left on y-axis, there is the yield, and you can see it runs from 1% up to 5.5% on this particular graph. And all that yield is your interest you own on your bond. Then, as we look at the bottom on your x-axis, we see that that's the term. And from the previous chapters that you learned in chapters 7 to 10 about bonds, you learned that the term is nothing more than the years until the bond matures, until the par value is repaid to the investor. So what this graph is a comparison between a yield and the term. So as we look at this particular chart, this is considered a positive yield curve because it starts over there with a short term of 1 year, and then the yield is this slow at about 2.3%. Okay, and then as you go further into the term, as you move right across the chart, that yield continues to increase, which naturally makes sense. You would think that this would be generally how all yield curves are, but they are not. But you would think that as the term increases, that yield one would be willing to lend their money and would also increase. So as we look at this for 1 year, we said that the yield is about 2.3%, and then as we would go clear over to the 30-year mark, we can see that the 30-year mark is around 5%. So if you are going to lend your money for 30 years, you would get 5% on your money based off of this yield curve. So you can see how that changes over time. When the yield curve is in a positive slope, investors might expect economic growth, which can lead to inflation and ultimately higher interest rates. Low yields for shorter maturity bonds and higher yields for longer maturity bonds, and then leads to economic expansion. Higher interest rates are negative for longer maturities. So investors demand a higher yield to compensate for this risk. Since the financial crisis of 2009, investors have been expecting economic growth and higher interest rates. These expectations resulted in a positive sloping yield curve. But occasionally, yields of shorter maturities are greater than yields of longer maturities. So the slope of the yield curve turns negative or inverted. An inverted yield curve forms when investors expect economic growth to slow down. If economic growth slows, investors might also expect interest rates to fall. These expectations increase the demand for the higher yielding maturities, which actually drives the yields of longer maturities lower. Historically, inverted yield curves have been leading indicators of recession. This was the case well before the financial crisis. Starting in 2006, the yield curve inverted and warned of the coming recession. And recently, towards the end of 2018, the US yield curve inverted, making the market panic. If you're going to buy a bond at 1 year term, you would get a 4% yield, and had a 2 year bond, it would be a 5% yield. And just so you know, if it is 1 year, it's not considered a bond, it's actually considered a bill. The proper terminology is a bill at that point. So, but as you go into the duration, you can see how this chart is going down. So the 30-year bond is below 3.5%. But if you're lending your money in the short term, you're actually making more. So that really does not make much sense to see a chart like this, which is very, very rare. Now that you understood positive and inverted yield curves, let's look at the third shape, flat yield curve on the screen. This shape forms when yields of the short and long maturities are roughly equal. A flat yield curve is usually a transition from positive to inverted or from inverted to positive. If you are going to lend your money for 1 year, you would get 5% interest or about 4.9% interest on this chart. And if you lend it for 30 years, you would almost make the exact same yield on your money, which really doesn't make sense. And you might be wondering why in the world that would be the case. If you are going to buy a 15-year bond, you would look at this chart and you go from 15 years right up until you hit the line, and you can see that you would get a 5% yield. So let's look at where we are. Current yield curve on 23rd June 2023. This is a US Treasury yield curve on the screen. But as we look at this yield curve, we can see in the short term the interest rates are high and long term interest rates are lower. When yields on short term bonds are higher than those on the long term bonds, it suggests that the investors expect interest rates to fall, usually in conjunction with a slowing economy. This is a leading indicator of recession. Historically, the yield curve has become inverted 12 to 18 months before a recession occurs. So, what's important about yield curves? Yield curve is a valuable tool that can help you as an investor understand what the federal government is trying and how they are trying to steer the economy. So when we look at the yield curve, okay, we see it flat. Let's say the whole yield curve is flat at 5%, like this one right here on the screen. Okay, when we think about that with how the federal government is thinking, they are trying to slow down the economy at this point. They are making the price of borrowing the money expensive, especially for that person in the short term and in the long term at 5%, because they are trying to slow down the economy. The forecast in the long term is exactly the same as it is in the short term. So you are typically going to see a flat or an inverse yield curve whenever the economy is doing well, because that's the way that the Fed is trying to slow down the economy, because they don't want a big bubble to occur. Because whenever the bubble gets too big, it pops and we go into a major recession. So the Fed tries to control that by these two. When you see these two charts, that's when the Fed is trying to slow down the economy. Now, when the Fed's trying to create spending in the short term, that the money you borrow is really cheap, and when it's cheap people spend, and in the long term they are predicting, when you go out to the 30 years, the estimate is over a 30-year period the average yield is probably going to be around 5%. So when we look at our condition where we are right now, June 23rd, 2023, you can see that the Fed is still trying to slow down the economy by increasing those interest rates higher and higher in the short term. And at the 30-year, it's only at low 3.82%. That's extremely low. So when we calculate the intrinsic value of a stock in the future chapters, we will be using the value found on the yield curve for the 10-year federal note. So if we go back to the yield curve on the screen here and we look at the 10-year mark, you can see that we are approximately 3.74% right in that range for the 10-year federal note. And now that might not make much sense right now as you are looking at this chart, but when we get into the next chapter, we are going to see how that applies when we apply it to our intrinsic value calculations. So I am going to show you something really neat. We are going to go to the US Treasury.gov website, and I have the website listed there below. And so if you want to go there and see what I'm doing here, that's the link. So here is our chart, and what we are going to do is I'm going to show you how yield curve changed over time with the Dow Jones. So here is our chart, and what we are going to do is we are going to go to the website. Okay, so as you can see, I have got the screen split into three sections, and I have the US Department of the Treasury put up on the right hand side, and I have the Dow Jones Industrial Average from 1995 up to 2000. If you don't remember that era, during that time the economy was going through a boom due to the internet, and so around 2000 we kind of saw the peak of the internet bubble. And then I have the graphical representation of the numbers on x and y axis. And so let's look. This is the treasury yield curve. Look back at the beginning of 2000. So you can change the dates right here. So we put in 2000 January, we hit go, and there is our chart. This is that this is what the yield curve looked like back in 2000. It was around like 6 to 7% as you go clear out to the 30-year term, which is a very high interest rate. That's a great interest rate. So you can see back in 2000, the federal government, they knew very well that what was going to happen, and you can see a nice yield curve and how they were trying to slow down the economy with very high interest rates across the board. So let's go ahead and look at what happened as time marched on after the year 2000. Okay, so you can see that I adjust the Dow Jones. Now it's from 2000 up to year 2011 is our time frame that we are looking after the Dow Jones. And you can see back in 2000 at the very beginning where we just pulled up the yield curve chart, and we had a close to flat nice yield curve, right? And it was at a high interest rate. So let's look at what happened when we go into the beginning of year 2001, which would be this time frame right here where my mouse is at. So let's go ahead and plug that number, change the date to 2001, and click go. But as you can see, it's actually starting to get a little bit inverted, which I said before is a very rare. So when you see that inverted yield curve, you know that there is probably something coming down the pipe where interest rates, the federal government's anticipating interest rates going lower, which means they are somewhat predicting a recession at that point. So almost a 6% yield at the 3 month bill. And as you go out to the 30-year, it's actually going down to 5.4%. So that time frame was right here at 2001, right before the 2002 crash. And it was not a deep crash, but it was somewhat of a crash back then. So let's look what happened to the yield curve in 2002, in 2003. So here it is for 2002. Look at what that yield curve looks like. You can see that the yield is very low in the short term, and in the long term, the Federal Reserve is predicting that the interest rate will gain over the 30-year period. But in the short term, they have got to keep them low. So let's look at what it looks like in 2003, where it is still a kind of a deep recession. There you can see that it's even lower. So Fed is trying to spark that economy. So there shows you how the Federal Reserve is basically showing you exactly what kind of situation you are in. So let's go ahead and look at the really deep recession in 2008, and we will start at 2006 to see how the yield curve changes over time. So let's go to 2006, and there you go. Fed already saw that the economy had recovered, that yield curve started going flat. And I bet you when we go to 2007, you are going to see that 4% to 5.5% yield curve is actually going to get higher because they are going to try to slow it down. So let's go to 2007 and see what happens. So there we go, 2007, and we are right here on this peak. Okay, we go and you can see that it's even higher. It's up at 5% opposed to where it was that before. Now you can see it's slightly getting inverted in 2007. Okay, so let's look at what happened in 2008. That's when they started getting the crash. And you are going to see that the Fed is already preparing for it. And you can see how you're starting to get a positively sloped yield curve. And that's the Fed's tip in their hand that there is a recession coming. Now, how deep the recession, nobody knows. Nobody knows that or can predict that. But you do know that there is a somewhat of a recession coming. Then as we go down to 2009, we are going to see that it get pretty drastic here, I'm sure. Okay, yeah, almost down to 0% on your short term, and then on your long term, it's still very low, rated 3%. And then let's go to the June 30, 2023, the current. You see that 1 year yield is around 5.4%, and 30 year it is very low at 3.85%, which is an inverted yield curve. That that means Fed is trying to slow down the economy. So hopefully that gives you an idea of how to read a yield curve and how you can use that as a kind of predictor as to what's coming next, and how the Federal Reserve is basically telling you how to look at the economy in the direction that it's going. So I hope that this tool really works out well for you. Remember that whenever we get into the next chapter, where we value stocks, we are going to be coming over here 10-year mark and moving straight up on this yield curve and reading that value, which for this date, June 30, 2023, it was 3.81%. So when we get in the next chapter, we are going to be using around 3.81% in order to calculate the intrinsic value of our stocks. So that concludes chapter 17, what is a yield curve. In this chapter, we learned two objectives. The first one is to know what a yield curve is, and the second objective we learned, how can I use a yield curve to predict market behavior. Thank you.